Hi, I'm Tom Dalton. This is the third video in a series of 4 about partnership distributions. In this video, we'll look at how to treat disproportionate distributions. That would be these 2 boxes right here. The purpose of the disproportionate distribution rules is to prevent a partner from avoiding ordinary income on the partner's share of ordinary income assets. For example, if a partnership has inventory worth $200,000 that costs the partnership $60,000, then a partner with a 50% profits interest would recognize half the profits when the inventory is sold. That's 1/2 of a $140,000 gain, or $70,000. The $70,000 gain would be taxed as ordinary income. Ordinary income tax rates top out now at 37%. A clever partner might instead sell his partnership interest or take a liquidating distribution at a $70,000 gain. Section 741 identifies a partnership interest as a capital asset, so the gain would normally be long-term capital gain. The highest long-term capital gain rate is 20%, much lower than the ordinary income tax rates. The tax savings in this example would be almost $12,000. It's IRC Section 751 that rescues the Treasury from this scam. Section 751 identifies the dangerous ordinary income assets as 1. Unrealized receivables, and 2. Substantially appreciated inventory. Unrealized receivables are essentially accounts receivable owned by a cash method taxpayer. The taxpayer completed the work for the customer, charged the customer, but has not yet collected. Using the cash method, the taxpayer recognizes the income and pays taxes on it when the accounts receivable is collected. Until it is collected, it is an unrealized receivable. An unrealized receivable full of ordinary income. There are a few other ordinary income producing situations that also qualify as an unrealized receivable, most notably depreciation recapture. Substantially appreciated inventory is what we would normally consider to be inventory sold to customers within a business. To reduce the administrative burden created by these rules, though, inventory is only included as one of the sinister assets if in aggregate it is substantially appreciated. Substantially appreciated means that the fair market value of the inventory, in aggregate, is more than 120% higher than the tax basis of the inventory, in aggregate. For example, if a partnership owned inventory with a fair market value of $119,000 and a cost of $100,000, it would not be substantially appreciated and could be excluded from the disproportionate distribution calculations. But if the fair market value rose to $121,000, then it would be substantially appreciated and therefore should be included in the calculations. In this video, we'll stick with substantially appreciated inventory to illustrate the somewhat complicated idea of disproportionate distributions. Here's a partnership with 3 partners. Each partner has a 1/3 interest in profits and capital. The partnership owns cash, inventory, and land. The partnership distributes all of the inventory to Adelina to terminate her partnership interest. Although this is a liquidating distribution, a current distribution has the same result. The inventory is substantially appreciated since the fair market value is 167% higher than the tax basis. Adelina's distribution is disproportionate because it changes the 1/3 interest that each partner has in the inventory. If the distribution is disproportionate, we suspend the normal distribution rules we talked about in the first 2 videos temporarily, and first treat the transfer of the ordinary income assets as a deemed sale, with recognized gain or loss to the partners. It is only then that we proceed with the normal distribution rules. In this example, Belen and Catalina have effectively sold their ownership in the inventory to Adelina. Since the inventory is worth $15,000 in total, the 2/3 sold to Adelina is worth $10,000, which is the sales price for the inventory. Belen and Catalina receive Adelina's share of cash and land in exchange for the inventory. As you can see, the sale of the inventory generates a $4,000 ordinary gain to Belen and Catalina. Belen will recognize $2,000 and Catalina will recognize $2,000. Their tax capital accounts increase by this gain as it normally would when they are allocated partnership income. The fair market value capital accounts do not change because each partner still has a 1/3 economic claim on the assets at fair market value. The tax journal entry for the deemed purchase of the land by Belen and Catalina would look like this. Notice that the tax basis of the land has also increased by $4,000, so that 1/3 of the land tax basis is now at fair market value. This is because Belen and Catalina paid fair market value for the 1/3 share of the land. And the balance sheet after the deemed purchase of the land would look like this. Next, Adelina has effectively sold her 1/3 share of the land and 1/3 share of the cash to Belen and Catalina. There is no gain or loss in selling the cash because the fair market value of the cash is equal to its tax basis. Selling her 1/3 share of the land, though, does create gain. 1/3 of the fair market value of the land is $5,000. This is the sales price, and Adelina is receiving 1/3 of the inventory as payment. The tax basis of the 1/3 of the land is $1,000. As you can see, Adelina has a $4,000 recognized gain on the sale. Because she sold the land, the gain is either Section 1231 gain or capital gain. Either way, it's taxed at long-term capital gain rates. Adelina's tax basis capital account increases by her $4,000 recognized gain as it normally would when the partnership allocates income to her. At the same time, the inventory gets a tax basis increase of $4,000. It is the only asset that Adelina now owns in the partnership, and she effectively paid fair market value for the additional 2/3 share of the inventory. The tax journal entry for the deemed purchase of the inventory by Adelina would look like this. The partnership balance sheet after the deemed purchase of the inventory looks like this. The last step is to distribute the inventory to Adelina by following the normal rules for partnership distributions under Section 732. IRC Section 732 tells us to distribute assets in the following order: first cash, then ordinary income assets, and finally all remaining assets. The only distributed asset here is the inventory, an ordinary income asset. The tax basis of the inventory within the partnership is $13,000. Adelina's basis in the partnership is also $13,000. So the tax basis of the inventory to Adelina after the distribution is $13,000. That all works out very nicely in this example, but it doesn't necessarily end up that tidy in real life. If Adelina's tax basis in the partnership interest before the distribution was only $10,000 instead of $13,000, then the inventory would have no more than a $10,000 tax basis after the distribution. If Adelina's tax basis in the partnership before a liquidating distribution was $20,000 instead of $13,000, then the inventory would have a $13,000 tax basis after the distribution, and Adelina would have a $7,000 remaining tax basis in her partnership interest. The remaining $7,000 tax basis would create a capital loss for Adelina because it would have no Section 1231 property or capital property to attach to. Disproportionate distribution tax treatment can be very complex. It's one of the more confusing aspects of partnership tax law. But if you map it out and follow a logical approach, you can get through it. This is the third video in a 4-part series about partnership distributions. In the 4th video, we'll see how partnership tax basis is allocated among multiple distributed assets.